Hello everyone, just wanted to give everyone an update on this bank failure situation as it continues to unfold. It's March 24th today. We woke up, Deutsche Bank was in the news, their shares are under pressure today. We had Credit Suisse that essentially went defunct last week and got bought by UBS. And this is on the back of after the Silicon Valley Bank, the Silvergate Bank failure and the Signature Bank failure. So it still has investors a little worried, saying, are we now seeing this problem spread to these more global organizations which create more risk? Or do we still foresee this as more of an isolated incident with some of these higher risk lenders? And I would probably say it's more the latter of the two still at this point, even though we see some of these global banks getting involved for what I would argue is other reasons than what we've seen Silicon Valley Bank get in trouble for. We were managing money back in 08-09 when the big housing banking crisis was going on, and we're on these analyst calls now, and I can tell you it's very different. There are not a lot of similarities between the two, and I'm going to be going through some of that analysis with you today. When we compare 2008, 2009 to what's happening in the banking crisis today, it's important to keep the size of these banks into perspective. So when we look at Silvergate was the first bank that failed, that was $11 billion. Silicon Valley was $200 billion. Then we had Signature Bank at around $100 billion. And then Credit Suisse, the most recent global bank that failed last weekend, that was about $575 billion. But as I mentioned before, Credit Suisse failed for different reasons than I feel the other three failed, which I will cover, but I kind of put them as an outlier. And then we have kind of First Republic Bank, which is on the ropes right now. That's about a $200 billion bank. So when you kind of hear those numbers, it made me ask the question, okay, how do these kind of regional or smaller banks in size, well, they're not small. I mean, we look at Silicon Valley Bank, $200 billion, not ridiculously small, but how do they compare to the big banks? Like one of the biggest banks in the US is JP Chase. They have about $3.7 trillion in assets. So if you add up Silvergate at 11, Silicon Valley Bank at 200, and then you add Signature Bank on top at 100, they don't even equal 10% of the size of the largest bank in the US. So when you talk about these mega banks, like, JP Chase, Bank of America, Citigroup, all these banks I just mentioned are over $2 trillion. So back in 08-09, it was the big banks that were in trouble, which is why it was so systemic. We are still talking about these smaller banks that are in kind of the few hundred billion, which again, not small, but not necessarily the systemic run on the banks. And also when we look back at 08-09, let's compare some of the failures. So the last big failure was Washington Mutual. That was a $300 billion bank. We had Bear Stearns go at $400 billion. And then we had the famous Lehman Brothers that was at $600 billion. So even those failure amounts, you look at like 300, 400, 600, much bigger failures than what we're seeing it today, even these 200 billion, 100 billion numbers. While you've heard a lot in the news about Silicon Valley Bank, I think it's very important to keep the profile of this bank in perspective to understand how truly unique it was. Now, while you've heard some high level stuff, it's also important to go another level deeper to understand why this could actually be contained to just a handful of these higher risk smaller regionals. So when you look at Silicon Valley Bank, in business 40 years, obviously when it was in business a long time, $200 billion in assets, 16th largest bank in the US, not a small institution, but they had a high concentration of lending to startup companies and VCs, which are just higher risk clients in itself, which other regionals and community banks might not have as much high exposure to. But the other thing that a lot of people didn't realize about Silicon Valley Bank is how fast it grew over the last 3 years. So while lots of banks saw a lot of inflows from all the stimulus money, they were extreme. So back in 2019, Silicon Valley Bank only had about $50 billion in assets. And then within 3 years, by the end of 2022, it had grown from $50 billion to $200 billion. So hyper growth. So again, a lot of banks saw growth. This was a hyper growth situation. And a lot of the money that was coming into this bank, not only were they lending out to more risky clients, but also they were making mistakes within their bond portfolio or cash reserve portfolio that also ended up hurting them in the end. Another statistic that I think is very important to understand a profile Silicon Valley Bank and some of these others that failed is the number of clients that were in their portfolio that were above the FDIC insurance limit of $250,000. So if you have balances under $250,000 at these banks, you are fully insured. Anything above that is uninsured. And when you looked at the depositors, Silicon Valley Bank, 90% of their assets were not covered by FDIC insurance, which means they had a lot of really big clients, where most banks have a more diversified portfolio, businesses, individuals. And when you look at individuals, a lot of them may have balances under $250,000. This also made it unique, and it also made it more subject to a potential run, because when you think about it, if you have big businesses that, let's say, have $200 million with this bank, how quickly can a business go just set up another business checking account and shift their $200 million over? They can do that pretty quickly, versus if it's $200 million spread amongst 4,000 individuals. What are the chances that all 4,000 individuals all at once are going to move their assets, knowing they have bill pay set up in their personal checking accounts? When you have individuals, the business tends to be a lot more sticky, which made these banks more susceptible to a run. What still continues to make these US bank failures more scary than in the past is the speed by which they're happening. This is the first time we have seen a true digital run on a bank, where you could literally go into your app and move millions of dollars at the hit of a button. Where back in 08, 09, these stories would develop over a few days, weeks. You would slowly see people start lining up at the banks. This can all be done online yet now. And the first day that the rumors started with Silicon Valley Bank, over $40 billion was moved out of that institution. So the series of events were Silicon Valley Bank announced their earnings report, and there was a footnote in the report that gave a hint to the trouble with their bond portfolio. They then tried to do a capital raise to fill that hole a few days later. They failed the capital raise, which then called all the VCs and stuff to go on Twitter and Slack to start warning people, saying, we have a problem, potential insolvency event, start pulling your money out. And then all at once, people started pulling their money out of the bank, and within 48 hours, the bank was in the hands of the FDIC. There are a lot of lessons we are learning as we see these things unfold. And one of the lessons, unfortunately, business owners and individuals have learned from these events, I'd say it's both a good and a bad lesson. And the lesson is, if there's risk of insolvency, you get your money out as soon as possible. I say that's a good lesson because people see how quickly this can unfold now and how quickly you have to make decisions. But it's a bad lesson too, because if there's rumors of false information, people might get very trigger happy and just start taking big action on very little information. As a small business owner, I look at having to make these decisions saying, if we look at a bank and there's rumors out on Twitter or Slack, there's an insolvency, how much time do I have to look at the information to decide whether it's credible before I start taking meaningful action to start potentially moving millions of dollars from one bank to another? I think this is going to be a big challenge for individual businesses going forward, is testing the credibility information and then speeding up the action behind it. We can see a lot of fear mongering going around, and it's panicking people thinking maybe my money in my community bank is not safe. We are still in a camp where we kind of look at the events that are unfolding and say it's still a high probability that this just may be a concentrated issue with some of these higher risk lenders. Again, when you look at Silicon Valley Bank, there's two main problems that plague them. The one is they were making loans to very high risk companies and individuals. So when you look at the startup community, they thrived when there was all this free money from all the stimulus programs. They grew and grew and grew. But then when all of a sudden inflation showed up and the Fed had to reverse course and start lowering rates and pulling the money back out, the startups get hurt the most. So they naturally had a client base that was more exposed to this monetary tightening policy. And on top of that, the money that was coming into them, they were making errors with their loan portfolio. So what they can buy bonds just like anyone else can buy bonds, but what they were doing is they were buying long bonds. And the short story is, if you're out on duration on long bonds and all of a sudden interest rates go up, you can actually take losses in those bonds that you otherwise thought were safe. And this is exactly what happened, is all of a sudden the depositors started coming to Silicon Valley Bank and saying, I want my money. These bonds were sitting at a loss because they hadn't properly hedged them and they didn't have enough money to hand stuff back to the depositors. And one of the other specific contributing factors to Silicon Valley is banks have what's called a chief risk officer. It's an officer of the bank for the sole purpose to understand the risk that this bank is taking as a whole between lending, between investing, and their chief risk officer at Silicon Valley Bank left in April 2022, and they didn't replace them until January 2023. So it was a good stint of almost 8 months where that chief risk officer was absent from this bank, which could have potentially prevented this from happening. I want to spend some time now talking about the Credit Suisse failure, which I think is very different than the failure of Silvergate, Silicon Valley, and Signature, which are those 3 US banks, which failed for similar reasons. The US banks failed, too much risk, problems with their bond portfolios, the whole 9 yards. Credit Suisse was a little bit of a different animal. We look at Credit Suisse's story and say they kind of already had one foot in the grave, and this whole banking scare just kind of pushed them over to where they were probably going anyways. When you look at the history of Credit Suisse, which is a Swiss bank, back at the end of 2011, they had about $1.1 trillion in assets. So they used to be a much larger bank. By the end of 2022, they only had $580 billion. This is before all this bank panic began in 2023. So they were already dwindling assets, mainly because they've had so many scandals over the last 10 years. They've had so many leadership changes that it wasn't clear whether they were going to make it. And then this last weekend, they ultimately got sold, a government broker deal sold to UBS for only $3.2 billion. And that was a Swiss government bailout. The government had to step in, broker the deal. They had to issue like $100 billion loan to UBS. They had to give them like $9 billion in backstops. So ultimately they ended up in the hands of this other bank. That has prompted clients to ask us, with the Swiss government bailing out Credit Suisse, where the US banks bailed out by the government are not, because Yellen has stood up there and said these are not bailouts. And it depends on your definition of bailout. If you use the 0809 definition of bailout for the banks, then the answer would be no, because in 0809, not only did they save the depositors, but they also saved most of the shareholders and bondholders, the investors of the bank, where this time around, the stockholders and bondholders went to zero, even though they backstopped the depositors. The other reason why you could say no is, at first they were looking for a buyer for Silicon Valley Bank, but one of the reasons why they may not have been able to find one is the government wouldn't backstop the losses like the Swiss government did for UBS purchase. So when you think about these banks taking over another troubled bank, so a private industry solution, they have 24 to 48 hours to make a decision on a bank that's in distress. And if you're going to buy one of these banks, you're going to want some guarantees that if it's bad, it's not going to take down my bank. And to our understanding, the US government wouldn't step in with any help. Now let's look at the yes group, the ones that say yes, this was a bailout. And we do tend to fall in that camp, mainly because when these bank runs started, the government stepped out and said, we will protect all depositors regardless of the amount, before they even knew how much they were signing up for support. And then 3 banks failed, they had to do it with 3. And our question becomes, they've kind of set precedents, because if all of a sudden First Republic goes under next, they're probably going to have to run the same thing, because we're not sure how you save these 3 banks, but not the 4th or the 5th or the 6th. So they really don't know how much they're signing up for, which might require government money. The other thing the government has at Treasury is called an exchange stabilization fund. So it's like $100 billion fund that they have sitting at Treasury. The sole purpose of it is to stabilize markets during turmoil. So one of the tricks that they were going to use is we'll take a few $billion from this stabilization fund to shore up these banks over the FDIC limits. But if it's at Treasury, where do you think that money came from? And even though it's not new money that came from the taxpayers, at some point that either had to come from printed money from the Fed or from tax rolls in order for it to be sitting at Treasury today. Now, regardless of what camp you're in, yes, it was a bailout, no, it wasn't a bailout. At the end of the day, it comes down to the question, did they do the right thing? Was that the right move? And we do agree that it was. I mean, you had a lot of panic. People have never seen this at the small to medium bank level. You potentially would have had people just out of unplaced fear running to every smaller regional bank, and the problem would have gotten much larger faster. They learned this lesson back in 0809 that if you don't get ahead of this stuff quickly, it can just continue to feed on itself. So by them stepping in and saying, hey, we're going to guarantee depositors, it brought some calm in while they had more time to assess the situation and calm the markets down. There has been public pushback to some of these bailouts, mainly because people look at the situation and say, listen, if you were trying to bail out the people that had over 250,000 on deposits, these were these startup millionaires and these VC billionaires, and the government just bailed them out. But I also say, remember, a lot of these accounts that were on deposit at these banks were to fund payroll for these companies. So if all of a sudden all those assets were frozen, no one was getting paid. So the big question of, does this get worse before it gets better from here? We could very well, and we most likely will, see other small to medium-sized banks fail in the wake of this. The market right now is looking under the hood of all these banks saying, how much risk do you have? How have you invested your portfolio? Did you make mistakes that similar to what Silicon Valley made? And it's tough to believe that there's only 3 banks out there that have overstepped their risk spectrum here in the US. So we could see more fail, but it's on the backdrop that the government has kind of set the precedence that we will back depositors. There have been a number of regulatory changes over the last few years in the banking industry that could have given rise to a lot of these events happening, but also give us pause to say there could be more bank failures from here. So the first change that we're looking at was back in 08-09, the last time there was a big banking crisis. The big reform they put through is called Dodd-Frank. So Dodd-Frank changed a lot of the stress tests, banking rules, all that good stuff. But one of the changes they made was they allowed banks to mark their assets to maturity. So this is kind of talking about the bond issue that Silicon Valley had. So they bought bonds, interest rates went up, the price of the bonds went down, but because Dodd-Frank allowed them to mark maturity, it means they didn't have to show the losses now. They could mark that bond to what the value was 10, 20 years from now that when it was going to mature. So it kind of masked the issue. So the question becomes, are they going to have to walk back mark to maturity and change it to mark to market? Another big change of the regulations more recently was the change of the stress test threshold. So back in 08-09, they created these mandatory stress tests for these bigger banks to make sure their risk stayed in check so we didn't end up in this cascading bank failure situation again. But back in 08-09, when this was first passed, the limit was any bank $50 billion in assets or above were subject to these more strenuous tests. Then in 2018, they moved that threshold up to say now only banks $250 billion and above were subject to these more strenuous tests. So as we talked about before, Silicon Valley Bank, 16th largest bank in the US, but they were only $200 billion. So they fell below that new $250 billion threshold. If they were continuing to be stress tested, would this problem surface before it became such a big issue? They might have to go back and revisit that regulation. The third regulatory change happened in March 2020, so it's the most recent one, but the Federal Reserve changed the reserve requirement for banks. So what happens is when banks take in all these deposits, they're required by the Federal Reserve to keep a certain percentage of money on hand to meet, their depositors' requests if they start taking withdrawals. And before March 2020, depending on the size of your bank, it was somewhere between 3 and 10% was the reserve requirement. Well, in response to COVID, they wanted banks to have the flexibility to lend out as much as possible to re-stimulate the economy. They actually lowered the reserve requirement to 0. So banks were no longer required to hold anything. If they wanted to, they could lend it all out, invest it, which could have led to some of the problems at Silicon Valley Bank because it was clear that they didn't have enough on tap to meet the depositors' withdrawal requests when they started flowing in. So they might have to revisit this and re-raise the reserve requirements going forward. The other element of contagion that we're still watching is the probability of a recession in the second half of this year. So while again, we still feel like this could be an isolated incident to these high-risk banks, the healthier banks could end up in potentially some trouble if we get into a recession in the second half of the year and all of a sudden people start defaulting on mortgages, car loans, business loans, commercial loans. While a lot of these healthy banks right now don't probably have the same high risk profile, some of these banks that failed, if they come under pressure and they own some of these long bonds that Silicon Valley Bank had, and then they have to start taking losses, will that put them in a capital crunch as well? And right now the market's trying to assess that, looking at the risk spectrum of each of these banks, saying who do we need to worry about? It's going to be very interesting to see how the small to medium-sized bank sector of the industry evolves over time. Mainly because anytime something big like this happens, regulation is coming next. And what regulation means for these small to medium-sized banks is more expense, right? If you have these more stringent regulations you have to keep up to date with, it usually means a higher cost to those banks, which means their profit margins shrink. Also, they're kind of fighting this trend that a lot of these bigger banks are taking in big deposits from these small to medium regionals just out of displaced fear. A lot of these small to regional banks are in probably very good financial shape, but people not knowing the full story may be moving deposits out, so they're fighting that trend. So we could eventually see some consolidation over the next few years if the costs increase, reserve requirements go up so they can't lend out as much money. It's going to be interesting to see how this evolves going forward. I hope this is helpful. If you have any questions, please feel free to reach out to me at moneysmartboard.com. Thank you.